Wonderful. Well, good afternoon and welcome everyone to the ACEC Research Institute's Future of Engineering Roundtable series. In today's session, the State of the Engineering Economy Q2 2025. Before we get started, I just have a few housekeeping announcements. For the easiest view, move your mouse to the top of your screen and select Gallery View. This will allow you to see all panelists. Your microphone was muted upon entry, but if you wish to ask a question or offer a comment, please feel free to type it into the Q&A box at the bottom of your screen, and we will do our best to answer as many questions as time permits. This event is open to the media, and the press is invited to participate, as with our other attendees, by asking questions through the Q&A box. We are also recording today's event for future viewing. If you require any technical assistance, please feel free to send a message to ACEC Research Institute privately through the Q&A box, and I will be happy to assist you. Now, allow me to introduce the Executive Director of the ACEC Research Institute, Daphne Bryant, who would like to say a few words. Daphne?
Thanks, Carrie, and good afternoon, everyone. We are glad you're here with us as we dive into some of the details around Q2 engineering business sentiment and other economic news. And there's a lot going on, as you all know. It's probably why you're here. Thomas and Joe have been busy trying to keep up with the day-to-day happenings of everything around the economy. We were just talking a minute ago about even more data that's going to be coming out tomorrow, which obviously we don't have a crystal ball to know what that is, but we're going to do our best to share with you our insights, as well as insights that we've gotten from all of you, our industry executives, through the sentiment study. So I do have with us today Joe Bates, who is the Senior Research Consultant for the Institute, and Thomas Grogan, who is our Senior Director of Economics and Market Intelligence at ACEC. And they are going to part their wisdom on us now. So Joe, I'll turn it over to you.
All right, thanks, Daphne. It's good to be here again, and welcome, Thomas. Good to always see you and do our tag teaming here. So today we're going to go through our usual three sections. We're going to talk about what's happening in the U.S. economy and this ever-changing environment that we are in. Then we'll talk about the current sentiment data and current industry data that Thomas has been tracking, and then we'll look into the future and do our very best, as Daphne said, to tell you what's coming down the road. But I think uncertainty and hesitation is still the primary word right now. So let's go ahead and jump right into it. How is the U.S. economy doing? Well, so very interestingly, and if you've heard Thomas or I talk more recently, you've heard us talk about this, but in Q1, GDP was negative 0.2. It was just recently revised from a negative 0.3. So not a lot of change, still slightly negative. And the reason it was negative was people were importing products from overseas to get ahead of the tariffs. And so essentially 6 weeks worth of product and services were front loaded into Q1 in anticipation of what might happen in Q2. So that's why you see that negative, because imports are actually a negative on US GDP until they are actually sold to consumers. So the big question is what's going to happen in Q2? Thomas, I have to kind of defer to you on this one. Just there's a lot happening here. What's your thinking on where we're headed right now?
Yeah, I mean, I think just in the past day or so, some of the, high frequency data, more up-to-date data says net imports have, like the drop in imports for May compared to April was like the biggest, in a very long time. When we look at the equation for how GDP is calculated, that ultimately will make, ideally or in theory, net exports positive. So we very well could have positive GDP, whether or not that is actually a good foundation for, growth going forward, or maybe it's masking more volatility is a little bit to be seen. But, I think to your point, we imported so much stuff at the end of Q1. It's kind of like when you hear a snowstorm is coming, you go and you stock up on all this water and soap and supplies, and then that sits in your closet for the next, a few months, if the storm doesn't happen, you don't need to go back to the store. It's very likely that will, ripple through to other parts of the economy and how households and businesses behave.
Yeah, and I think you raised a good point about inventories, right? If all of those goods are sitting on shelves in stores and not being sold, well, that's not going to help the economy. But on the other hand, we have a little bit of data that we'll share in a minute about consumer spending. So we'll save that for just a second. On the jobs front, we did have a good read in April and March. Now, what was interesting to me was that March reading that we had was actually, I'm sorry, the April reading was supposed to come in around 130,000. That was the forecast, but it actually was much higher. However, the March and February numbers were revised downward almost the same amount as the April numbers were up. So there really wasn't a big positive there, in terms of the actual averages. So and we have seen the labor market slowing. This has been happening for a couple years now. On average, the monthly average in 2023 was 234,000 jobs a month. In 2024, that was down to 179,000. And now if you average out the 4 months we've had so far, it's 144,000. So that, we are seeing a slowing labor market, but unemployment is still very slow. Thomas, what's your thoughts on our tomorrow? We're going to get the May job numbers tomorrow, forecast to be 130,000 created jobs or so. Do you think it's going to come in or be light? What's your thoughts?
I would probably say that's probably pretty accurate. I think other ways of measuring the job labor market are, also showing different signals. We know that the most recent report of job openings increased a lot, right? Which basically means businesses are looking to hire people, right? It's mixed signals because, they're not only hiring people, then they're also looking to hire more, but also, weekly unemployment had a bit of a bump last week, or the most recent reading. Some of that has to do with, Memorial Day entering the summer and some seasonality there. So I think, if the numbers can be within, plus or minus 5% of what's expected, that's probably pretty good. I think a significant drop down, like below 100,000 is going to be cause for concern. And then, I think everyone is feeling like we're on the seesaw of no one wants to make a definitive prognosis that we're definitely heading towards decline or we're definitely going to be okay. And so that will kind of tip some of the scales in one favor or another if that happens.
Yeah, and the ADP numbers, which do not correlate at all with the US job numbers. It's worth noting, though, that they came out yesterday and they were much, much lower than expected. It's interesting for me to watch those numbers, but I put no weight in them because they just do not correlate with the US jobs report. So we will see what happens tomorrow. Now, coming back to the consumer, we do see that in March we had a consumer spending increase by 0.7%. That's a very, very good number. Again, that also goes along with this idea of consumers front loading their purchases. And then we see a little bit of a softer monthly read in April, but still positive. So the next report is going to come out not until the end of June. And of course, I meant to mention, Thomas, those second quarter GDP numbers won't be until closer to August. So we have a long time to wait for the big numbers. But as you said, some of the high frequency numbers are kind of, this is good, this is not as good, this is better. It's a little bit of back and forth right now. So, the other thing I always talk about is the labor shortage here in terms of labor force participation rate. We're still seeing that. It's not moving significantly. We've been talking about this for a long time. So, we'd love to see more people who are eligible and able to work to actually enter the workforce. That would help ease some of the labor shortages that we've been experiencing. Now, let's turn to inflation. So this is the CPI. We get a read on this again for May next week, Thomas, right? Am I correct?
I believe so.
Yeah. So what we saw in April, we did see moderating numbers down to 2.3%. Now, this is overall. However, the core rate is still at 2.8%, and that's kind of elevated. It's not close to that 2%, it's closer to 3%. So the big question is, what's going to happen? And what are your thoughts on that one, Thomas? This one is also kind of befuddling me lately.
Yeah, I mean, I think some of the other things we'll talk about, you know, stepping aside, it's generally prices are in the direction that we have been hoping they'd go in, or getting to levels we've been hoping they'd be at for like 3 years, right? Let's say 3 years ago was basically when the Federal Reserve started raising interest rates. 3 years ago when we had June of 2022 with that massive spike, right? And that was the highest monthly. I mean, look at how much higher that has been over the previous 20 plus years. So that in and of itself is good. I think folks were hoping, at the end of last year going into this year, the prices would continue to go down. And then that was kind of giving a lot of confidence to markets that the Federal Reserve would then be cutting interest rates, right? Because they would feel like prices are closer to their sustainable level. Issue though is we're not in this vacuum, and there's a lot of volatility around other, federal policies, around trade and tariffs that we will talk about that can have large impacts. Also, it goes into the supply chain, the disruptions there, supply and demand issues. So needless to say, we're at least in a good place from the price perspective, that if there is more uncertainty, and unfortunately, if prices go up, we're starting from a lower baseline. I'd rather prices be rising and us be at closer to 2% than prices rising and we're still at 5, 6, 7% year over year growth. So, that's kind of all to say. We don't totally know. It doesn't seem like prices. I would be very surprised if when we do this, in the fall, we see that prices have continued to trend down. We're kind of, this is maybe as good as it gets in terms of low prices. So
Yeah, that's my sense is the same on that one for sure. The Fed is not going to lower rates if the labor market stays healthy and interest or inflation starts to go back up. So I think that's what everybody is talking about. So some of the sentiment data we have from Q2, and I have to set the stage here. We conducted this Q2 study in the first and second week of April. That's right when the tariffs were announced. And so there's absolutely some reaction to those tariffs and what we were feeling at that time. So please keep in mind when we talk about Q2, we are talking about the beginning of April of this year, the first 2 weeks of April. And when we talk about Q1, it was right around the time that the new administration took office. So keep those 2 dates, they're very significant. Now, to add to this, we're conducting right now a mid-quarter update. If you have received the email to take that survey, please participate if you have not already. And we'll send out a final reminder on that tomorrow. So we're going to have an update on these numbers mid next week because so much is changing. We need to provide you all with an update on where things are heading. So as of Q2, these inflation worries jumped back up to their highest level in more than a year. What we're seeing at the moment, and again, results aren't complete, but we're seeing some easing of inflation concerns, but they are still elevated. That we're somewhere in between Q1 and Q2 now. So people are not as worried as they were 6 weeks ago, but they're still more worried than they were back in January.
Hey,
So
Joe,
Thomas,
could
you got some slides.
Joe,
Oh, sorry, Daphne.
I'm
Yeah.
sorry. Could you take just a minute and explain the net rating system just for anyone that might be new?
Yes, of course. Sorry. So we have a net rating system. What we do is we take the percentage of positive responses and subtract the percentage of negative. And so in this case, the question is worded, I'm extremely concerned about the impact of inflation. So if you say, yes, I agree with that, it's going to be a positive response. So a plus number here is not good, whereas on all of our other metrics, a positive number is actually very good.
Thank
So
you.
you'll see these net ratings throughout our presentation today. All right. So Thomas, talk a little bit more about the inflationary pressures here that you're seeing.
Yeah, this is basically looking at kind of regardless of whether we're including or not including certain components of the consumer price index, but essentially prices, when the year started, were up 25% compared to, pre-COVID. And the one, like I said, good sign is that the past few months it has been slowing down. We see, it really started to grow or take off January 2021, where essentially you kind of had a lot of volatility and things happening during 2020 that didn't, it's like kind of like almost like kinetic energy before that transfers into the actual momentum. There's all the stuff brewing, and then it really spiked up. It almost seems like, similarly, well, we don't know what's going to happen, but right now, the hard data is somewhat leveled out, though we know there's a lot of volatility about these other things. The question is how much is that going to make things potentially spike going forward or not? But things for households, things are 25% more expensive, and that's in over the past 25, 30, 35 years, I don't think we've had a rate of change so high in such short amount of time. So it's kind of, as we, talk about a lot of different new normals, this is part of one of the new normals.
And usually, and in this case, the average family household's income has not kept up. Like that's just a fact.
Right. And so, when we kind of break down what we spend money on, I, use this chart to really illustrate that you basically, everyone buys either a good, which is a physical thing, or a service, which is, basically someone's time. And, again, to maybe provide some context around what can be the impact of some of the different tariffs or trade policy uncertainty, what we see is while all items have increased over time, goods has been fairly stable. It did have a fairly pronounced rise in costs, post COVID 2021 onward, but we see that it reacted very quickly when the Fed started raising interest rates in the spring of 2022, and those costs, basically plateaued for items, where services, which are labor and wages and insurance costs, things like that, have continued to go up and up. The past few months, services itself has actually started to flatline, which I think economists had been hoping services would react the same way in April of 2022 that the goods reacted to, but they did not, right? They kept increasing. And that is the bulk of what households spend their money on. About 65% of what a household spends its money on are services as opposed to goods. So, it's thinking through how certain tariffs will increase the cost of items. I think we have to keep into perspective that it's going to affect, not only, but 35% of what you are spending your items on, and that is, not your total household budget. So it's not like, something like a 50% tariff or 100% tariff means all prices are going up 100% tomorrow. It's going to be pieces here or there that still can have a meaningful impact on balance sheets and budgets, but I don't think maybe it would have as astronomical an impact as it, maybe folks were thinking April 2nd or 3rd, whenever, the first round of changes were announced.
Yeah, and those interest rates you're talking about, we don't have a slide on it. We sometimes do, but they've been hovering in terms of like the 30-year mortgage rate, which
Right.
we look at a lot, is been hovering anywhere between 6 and 7%. And now it's back up around 7%. The 10-year Treasury note, which really has the biggest effect on interest rates for consumers, is about 4.5. It's kind of going between 4.4, 4.5 and a half. So a little bit elevated on that side as well. So lots of dynamics things happening right now in that area.
And so then if we look at, our industry and how prices have changed for, different components, we see that on the construction side, that plateauing with the interest rates where, the cost of total non-residential construction kind of flatlined out in the spring of 2022, while the architecture engineering services have continued to rise, essentially since January of 2023. Our industry's costs have increased 5x compared to the construction component of a full project life cycle. And so, again, thinking about how tariffs are going to impact things, it's going to be tricky. The only, maybe benefit or part that we could be somewhat optimistic about is that the components of construction, your cement and steel and other things like that, have been flat and normalized a bit for the past few years. So that is tough, but still, just looking at it, delivering a non-residential project is costing 60 to 80% more today than it did 15 years ago. That's a lot, and just compared to pre-COVID, I think it's about 40% more.
Yeah, so lots of inflation that's sort of already baked into the system there. Daphne, any questions so far for the first section on the U.S. economy before we move into the AE industry?
There was some questions around tariffs, but I think they will pertain more to the upcoming section, so I'll hold on to those for now.
All right, very good. So let's move on to the second section. How is the AE industry doing? And Thomas, I know this particular chart, it has not the most recent data, but tell us what you're seeing here and what you think is going to happen with Q1.
Yeah, so 2024 ended pretty strong in terms of total revenues in the industry. We also saw that employment, number of folks being hired by firms also picked up a bit. I think when 2024 began, there's maybe a little bit of a dip on the employment side. I think the growth rate had dipped a bit too, but really ended strong with 11.7% year over year growth. That was for 2024 Q4. Then 2025 Q1 numbers unfortunately don't come out until next Thursday, I believe. So we don't know where it will be, but I think we can pretty confidently say it's not going to be 11.7% year over year, just when we look at how our industry moves with overall construction spending, which I know we'll touch on in a bit, but that we have more recent data and it's been off to a slow flat start to 2025.
Okay. So you have some more data here to share with us and the sort of big hole for Q1.
Yeah. And, essentially we see how employment, the dashed line is just the year over year change in employment. And it's, has less variance up and down the way revenues move. You see that, that's been fairly consistent even when we had the dip during COVID. There wasn't, say, a huge amount of layoffs per se. That has been even, towards the end of last year, a bit above trend. I think maybe the average was like 2% and we were at like closer to 3%. But we don't know where 2025 Q1 will be for revenues, but just looking at how things have performed historically, it's probably that gold line is going to be sloping down.
Okay. And then construction spending, you were just talking about construction and how we're seeing a little bit of a dip there.
Yeah,
So,
so the most recent data came out at the beginning of this month. Essentially now, April's month over month seasonally adjusted rate was down 4%. That's the third consecutive month in a row where it's been down 3 months in a row. The last time we had that was spring 2022. Obviously, though, with hindsight, as we step back, we see that we came out of spring 2022, continuing to basically grow at double-digit growth, maybe less optimistic going forward with everything else that's happening in markets and policy. The one bright side is that public has started to continue to tick up, that though only makes up about a third of total spending. But yeah, the start of 2025 on the overall construction has been pretty anemic.
Okay. And then this one fascinates me, Thomas, about residential construction and non-residential construction. So
Yeah.
let's talk about this for a minute.
Right. So, I mean, coming out of COVID, residential, really grew a lot, fueled primarily or not by low interest rates, right? Low cost of capital, and then other things happening with, being able to work remotely, people reevaluating their lives and where they want to live and all that bigger esoteric stuff. And then we see in this series, similar to what happened, in the cost of goods, when the Fed started raising rates and basically the cost of capital increased, the economics of buying a home and, what your monthly mortgage is going to be changed. And we see that basically plateau, and it came down, but it kind of had flattened out, about a year and a half after interest rates basically had normalized. It starting the year declining even more, I think is a pretty big surprise. I was actually flipping through some information from a presentation basically at the very beginning of the year, and folks were pretty optimistic that residential would, kind of continue, maybe not have significant growth, but would continue to grow because folks have settled into this new normal of what the cost of capital is. But that's not the case at all. And, I don't have specific insight into why, 3 years after mortgage rates have been above 6%, that it's not sustaining. Some of it could be, folks have run out of savings. The labor market is about the same when we look at where the unemployment rates were. So folks are still employed. Maybe a bit of it is just demographics with where people are in their life and needing to move or needing to own a home or not. But that is kind of a bigger concern and something to monitor, because what we've seen over time is maybe when there was slack in the non-residential market, the residential market picked up. And then conversely, in 2022, when the residential market came down, the non-residential market grew a lot with, a lot of the manufacturing. Manufacturing definitely accounted for a large amount of that. Manufacturing spend has been declining, over the past few months. So it'll be interesting to see what other markets can potentially make up the slack there, because some other ones that are sensitive to interest rates, have continued to decline as well.
So we always like to talk about which sectors are doing better and which sectors are doing worse. No surprise there already. Thomas, you talked about residential not doing very well, but
Right.
Where are we seeing growth, and where else are we seeing some struggles?
Right. So, that I think are sectors that also have growth and have growth that have some weight to them. The water sector, is growing pretty well and robustly when we look at sewage and water supply. The amusement and recreation sector is also growing pretty well. Not included, but growing, positively is power. And I think, for folks who've heard me talk over the past 6 months, things related to, this kind of basic / critical infrastructure of power utilities, things like that, those seem to be, needed and needed. They're not like a nice to have. You need the water running in your house. If you don't have the water running for a few hours, that's an inconvenience, let alone days or weeks. And similarly for power, right? And so that and what is projected for the demands for, demographic growth, as well as, the growth in data centers, as well as just electrification in general, and what is needed to support that as we continue to move forward. That just kind of requires, the money to be spent there. It means something like lodging, which was hit obviously by the COVID and the pandemic that we saw because people traveled less, and then as we kind of go forward, and household savings has declined and maybe people aren't going on those 5-day, getaways to, spend thousands of dollars for a Taylor Swift concert in a city across the country, that's going to get cut a lot sooner than, not paying for your utility bill or something like that. So those sectors, I think, seem robust and should continue to perform well. But these sectors, especially, commercial folks, in 2023 seem to think, okay, with this interest rate rising, eventually they're going to get cut. But they haven't been cut for 3 years. And I think that can be problematic, especially, when you think about how people get locked into different leases at different rates and, hoping that rates would be cut in the future, but them not being cut just makes, everything more expensive. So that is, in addition to the residential market, commercial has been something, we've talked about keeping an eye on because of, what's happening. Some of it related to the interest rates and cost of capital, and some of it, related to the overall shifts that have happened coming out of 2020. You look at downtowns, a lot of major urban core downtown areas still not have come back, and that is problematic as well.
Hey,
All right.
Thomas, we got a question related to this. And are firms seeing any different levels of opportunity, public versus private sector work? So you talk about, kind of the different markets here, but can you talk a little bit about just the public-private in general?
I don't know the answer to that right now because, at least with respect to when we looked at the data, this was the first month that public performed a lot better than the start of the year. And I think there was a lot of volatility with what was happening with changeover in certain programs. What was going to be continued versus what isn't being continued. And then just with other changeover, right? There's like the actual logistics of someone working for the government pressing the button to issue the RFP or give you the payment for your project. And if, just like in any job, when certain priorities come in or come out, other things get paused or, maybe aren't moving so slowly. But, I think, I can't say definitively one way or another which one has a better opportunity right now, or I have not heard more, but I think maybe I'll look forward to see what some of our advocacy folks have to say after some of these bills get passed or reauthorized in terms of what spending has been carved out for what.
All right, so let's go on and look at some of the sentiment data now. Thank you, Thomas, for all of that great data that you have shared with us. So again, keep in mind Q2 was back at the beginning, first half of April. So we saw the sentiment for the U.S. economy increase in Q1 right around the time of the inauguration, and a lot of optimism regarding maybe easier permitting processes, fewer regulations, a more pro-business environment. But obviously that fell quite dramatically around the tariffs being announced. So again, an update that we will have next week will show you that we're not in, the optimism isn't quite as soft as it was 6 weeks ago, but it's also not at the levels it was back in April. However, looking at the industry, that kind of took a little bit of a hit along with the U.S. economy. So optimism regarding the industry, while still extremely strong, plus 73 is very, very strong. We're not seeing, we saw that affected by the overall concern about the U.S. economy. And our mid-quarter update, which we'll release next week, this number looks like it might have even gone down a little bit more. So that's kind of interesting to see that folks are a little less optimistic, maybe just a little more cautious about what's going to happen to the industry given a lot of these uncertainties. Firm finances, however, are continuing to do well, and our mid-quarter update will show you that they're still very strong as well. Now, when we go back and look at these sectors, so a lot of these numbers really do jive well with what you're talking about, Thomas. I circled the blue or the highest sentiment sectors in blue and the lowest sentiment sectors in red, just to help folks focus on that. We, of course, saw across the board decreases almost in all areas with respect to quarter over quarter. And of course, year over year, not surprising given the timing of this. But nonetheless, the strongest sectors are data centers, which we've seen, energy and utilities, which are tied closely to this data center, water, wastewater, which you were talking about, Thomas, airport transportation, as well as roads and bridges. Although you were showing, that being a little softer perhaps in terms of spending. But we also see commercial real estate as one of the lower performers, residential land development as the lower performer. So that goes very well with your data. But we also see, of course, the lowest, one of the biggest declines, I should say, in the sectors was government buildings. I don't think that's a surprise given that we're seeing a lot of talk about cuts in government spending. So all of these numbers, I think, very much fall in line with what we're hearing and seeing and would expect.
Hey, Joe,
Now,
before you leave that one, this is where I think the tariff question that came in earlier fits in nicely. So just recently the tariff announcements on steel and aluminum, right? A lot of these markets you have circled rely on those products. And so the question is, what impact do you think those are going to have on these markets in the coming months, assuming that those tariffs stay in place as we know them this week?
yeah, so let me give a few stats on that, and then Thomas would love to hear your thoughts. So we import 28% of the steel that we consume in the United States. So that's a pretty decent sized chunk, and obviously a 50% tariff on that is going to have an effect. Aluminum, we import 85% of what we consume. And of course, that goes to airplanes, cans, consumer products, a lot of, cars, things of that nature. So that's a pretty big number. And our major trading partners in those areas are Canada, Mexico, and China, of course. So that's some numbers. Thomas, what do you think is going to happen if these don't get removed?
Yeah, I mean, I think certain sectors will probably be more sensitive to the increase in the costs, right? Especially say like the private sector in general is maybe going to be a bit quicker to cut something if they, do their calculations and figure out the ROI is not what they want for developing a site for, a commercial warehouse or something like that. Other sort of projects like power or water, that, as I said, are maybe more needed or more dependent upon, they'll figure out a way, I think, to get the money to pay for it. Conversely, on the public sector side, there's a bit more certainty, usually when you sign a contract with a government entity to, deliver X for Y dollars, that, when that starts, obviously the profit margins might change because of costs, or maybe a government will only be able to build 2 projects instead of 5 because of the cost, but they will probably spend the money and kind of go through with that project when you're in a certain phase of development. I think the more volatility and uncertainty is going to be around some of those private projects where they have a bit more, or it's basically different ROIs for doing and finishing a project on the public sector versus the private sector. And, all of that gets into play. I think too, we don't know what's going to happen with a lot of items we use with respect to like national security and importing different chips or digital sensors, or all this that goes into, facilities, especially things like data centers or water or energy monitoring systems. So, needless to say, I think there will be a lot of volatility around those projects, or there, potentially could be just because of what's happening. But, as we've talked about as well, we're doing this webinar on June 5th, just 2 months prior. How we are answering these questions have changed a lot, right? So that's always one thing to keep in mind.
Yeah, and obviously steel and aluminum tariffs were just announced. It could be that they're rolled back next week. So, it's really hard to predict these things.
Yeah, and I mean, one thing is they are not a big importer, but because of the deal that has already been done, the UK is the one country that is exempt from this, right? Because they already have a deal, and I think that's the thing, as anyone who's tried to get into how tariffs can be affected, is that there's like 8 different variables depending on the product, the country, how it's classified. We have all these different sections and agreements that do exist or don't exist, or we're making new ones and trying to like mix and match all of that to figure out what the real rate is pretty tough.
Yeah. So when we turn to backlog, we are seeing a bit of a downward trend here now for the last 3 quarters. And this is, something that's of interest to me. We haven't seen a median backlog of 10 months for quite some time. It's been sort of hovering between 11 and 12. So this could also be why we might be seeing a little bit of softening in the industry-wide sentiment, that overall perhaps people are seeing, well, there are some projects that are being delayed. There are some projects that might be canceled, or maybe there's just some slower, the pipeline's a little bit slower. So this is something we're going to be taking a very, very close look at come Q3 in July, when we have the Q3 sentiment study. So keep an eye out for that. The full report, of course, which will show you a QR code in just a moment, has a lot of detail by region of the country as well as by firm size on a lot of the different metrics. So backlog is certainly one of those. We also see here, when it comes to hiring, we're still seeing very robust demand for labor within our industry right now. 9 out of 10 firms still have open positions. I've been saying that for years and years and years now. Our median did go down to 5 from 6, and that's mostly attributed to the larger firms, those with 500 or more FTE. And we've seen a bit of variability in the last year among those larger firms. So we'll look at future sentiment in just a moment, because I think we'll get some better insights into what might be happening coming down the road. And also, in terms of open positions as a percentage of overall FTEs, we also see that having notched down a couple percentage points. We've not seen it at 7% before. It's always been at 9 and one time at 8. So we are seeing maybe a little bit of slowing of hiring, not a slowdown, but obviously there's still a shortage of labor within the industry, but maybe just a little bit more delaying of some open positions, perhaps. We saw earlier this week we heard about some hesitation in hiring from the ADP numbers. So there's some possible slowing and moderation of growth here in the jobs, but still very, very strong demand within our own industry. All right, so let's take a look at what's coming down the road. This was probably the most dramatic slide, in my opinion, that we had from Q2. Is the future sentiment fell the most it's ever fallen in the history of our study, which is going on almost 4 years now. So the U.S. economic sentiment turned negative in terms of the future sentiment. This is asking folks 12 months from now, how do you think the economy will be doing, better or worse or about the same? So on average, you see people thinking that a year from now the economy is going to be doing worse than it is today, or as it was at the beginning of April. And also the condition of the engineering and design services industry. There was a slight edge there on the number of folks feeling that it will get a little worse. And now it's still very strong, as we've noted, but perhaps some softening. Firm finances, people are also saying, well, maybe not improving as much as we've seen it improve over the last quarters in terms of our thoughts about a year from now. So definitely some hesitation about future sentiment. That is something that we're going to keep an eye on as well. We'll talk about recession concerns in a few moments, But when we look at sector performance 1 year from now, we also see a lot of red here, quarter over quarter and year over year. So future sentiment in in every sector took a pretty big hit in the second quarter. Again, we need to see if this bounces back in the third quarter and by how much. I do think it's going to bounce back, seeing as what we're seeing with our mid-quarter update. But how much does it bounce back? We have a lot of negative numbers now in terms of future sentiment overall. A year from now, we only have a handful that have positive sentiment: data centers, energy and utilities, manufacturing facilities, water, wastewater, and roads and bridges. Everything else, well, telecommunications is almost flat, but and airports. But most everything else is now in the negative for 1 year out. So again, we'll see what happens in Q3, but this clearly shows the sentiment turned sharply negative around the announcement of the tariffs. Those individuals who felt negative or more pessimistic about the future of the economy or the industry or firm finances were asked why. And the number one reason was political uncertainty in the political environment. And that was up at 91%. It's never been that high before. So that is certainly on people's minds. General economic uncertainty, recession concerns jumped compared to the first quarter. Inflation and rising cost concerns jumped. The impact of tariffs, we had never asked that, of course, before, but it was quite high at 75%. On the other hand, folks are feeling a little bit better about the workforce. Maybe there's going to be a little bit more easing, as we talked about. And on the second slide here, we see most of these metrics are easing as well, but we saw a jump in the supply chain issues. Again, perhaps people are concerned about tariffs causing disruptions in the supply chain. When we look at future predictions of backlog, it's almost flat now. So again, Q2 in April, people were feeling the heightened level of concern about what's going to happen a year from now. And I think there's still a lot of uncertainty and a lot of concern, but I also think people are feeling a little bit better, perhaps, that the tariff impacts may not be as dramatic as initially thought. So we will see again what happens there. Future hiring, here's where I was talking about it really slowing down quite a bit. And again, this may stick. We've seen a lot of other indicators that firms and companies around the economy at large are just a little bit more hesitant about filling positions at the moment. And they certainly we're not seeing layoffs, as you mentioned, Thomas. People want to hold on to their workers, even if we're seeing a bit of a slowdown. Everybody knows that it's hard to hire new workers. It's costly to hire new workers. And that usually is a lagging indicator anyways. So right now we're just seeing maybe a little bit more caution in terms of what people are thinking about a year from now, but still very positive. There's no feeling that we're going to have a decrease in the number of job openings. Recession concerns, as I alluded to before, this is kind of interesting to me. Again, it jumped dramatically in Q2 up to 54%, pretty much across all regions and all firm sizes. It went up similar percentage points. But in our mid-quarter update, as I said with some of the other metrics, we're still seeing an elevated level of recession concerns. It's not as high as what we saw in Q2, but it's definitely not down as low as it was in Q1. So keep your eye out next week. We'll be issuing a report next week, probably on Thursday, to update some of these numbers. Not all of them, but it's a short survey so that we could try to understand what's happening. All right, the last section, we're going to talk about remote work. So one thing that's really interesting, we always ask some hot topic questions in the sentiment survey to see what folks are thinking and feeling about different aspects of work in the industry. And so in this case, we asked about remote work. This was interesting. So compared to the last quarter of 2022, more firms are allowing remote work, and there's more flexibility than there was previously. But you can also see that more firms are requiring employees to work at least part of the week in the office. So there's more remote work allowed, but there are also more requirements around those remote workers. And so that's kind of been a very interesting change. But nonetheless, we're seeing that this flexibility in remote working is very much staying, but changing slightly in how it's being administered. And here's where we see how it's being administered and what those requirements are. More than half are requiring 3 or fewer days in the office. And look at that big jump in the threes, right? So that's become more common than not. It's not a majority, of course, but it's sort of the most frequently cited number of days. So the three seems to be where people are settling. But there's also 13% of companies that are only requiring their workers to be in the office 1 or 2 days a week. And many fewer are requiring those 4 days. So very interesting to see that, that we're seeing how this is all played out 5 years after the pandemic. And, we'll continue to monitor this from time to time. All right, Daphne, over to you for questions.
Yeah, I've got a few. So the economic uncertainty, how do you all think that's affecting firms' decision making? Is it slowing their decision making around investments, around expansion? Any indication on those metrics?
Yeah, I'll take that one first, Thomas, and then see what you think as well. What I'm hearing from some of the leaders that I've talked to is that there is an increase in the uncertainty, as we talked about, and they are kind of putting a pause on certain aspects of the business. Some firms are seeing contracts being delayed and canceled, and that's causing them to be a little bit more cautious. Other firms, though, I've talked to have said, no, we're doing quite well. Everything's normal, and we're not seeing too much impact. Now, I also think it has to do with whether you're more heavily into public contract work versus the private sector. And a lot of the firms I've talked to said, yeah, it's they're seeing some real impacts in the public sector. So I think there is definitely some hesitation, and that's what I'm hearing and seeing. But Thomas, what are you hearing from folks you talk to?
Yeah, I mean, I think the firms I've heard that, have been impacted has had to do around public sector work. And then I think on the private side, the uncertainty that exists has kind of been around for a few years now, or, like to talk about commercial has been declining for a bit, right? So if you were in the commercial real estate development space, you probably were adjusting and coming up with a new strategy in 2023, 2024, so that, you're navigating, there's many different waves that are rippling through different sectors at different times. Others, that are maybe focused on kind of more super critical components of building safety or things like that seem, that's not going to be slashed from budgets. I think there's also just, other uncertainty that folks or firms have had to deal with and will continue to deal with around. We know there's been a lack of labor, and what does technology mean on your workforce and all that. And they seem to be continuing to, focus on that and move forward, right? Trying to separate the signal from the noise. So ultimately, I think it kind of depends on who your end market was, and the ones that were working on public or with public clients had more disruption or impacted by the uncertainty more.
Thank you both. I have another question, Joe. I think this is probably referencing back to the sentiment, the current sentiment that you showed early on in the session. And so they're asking, despite the economic concerns, right? We saw the big drop on the US economy, but the industry and the firm's finances are still holding pretty strong. The industry had a little bit of softening. Firm finances are still strong in the 80s. And so the question is, what do you think is contributing to that resiliency?
Well, we've seen backlogs have been very healthy for a very long time. So I think that's one thing, and that's why I'm a little concerned to see the backlogs dropping just a little bit.
Yeah.
Obviously, IIJA still very much is a tailwind and helping to push the industry forward. So I think there's a lot built into the system that is going to continue to help keep our industry healthy compared to maybe some other industries that could be slightly more affected. So that's my take on it. Thomas, any additional thoughts on your end?
Yeah, I mean, I think to your point, the backlog and kind of a little bit of the dynamics, we've talked about this in some previous sessions where, right, you have supply and demand, and firms have been saying they haven't had enough work supply to keep up with the demand, right? Like there's more work to be done than they are able to do. So if that demand comes down, that doesn't necessarily mean their work is coming down because, hypothetically 10 or 15% of the work wasn't getting done right? So there's like some slack in that, might play into this. The thing is, that decline in demand and that delta you can only sustain for a little bit, and then eventually that really will boil over to impacting the firm. But it seemed like there was so much kind of growth and opportunity and demand that will allow for some of this pessimism or decline to not have a significant impact on the firm.
I think to that point, Thomas, too, we know from some of our past quarterly sentiments that firms have gotten a lot more selective about what projects they're taking on, right? Or even what
Right.
projects they're going after from a bidding perspective. And so to your point, as that slack kind of comes into play, then you're still feeling good about the amount of work you have to do, and maybe even some of the work that you've turned down in the past.
Yeah, I mean, I know that used to be like 9% of, there's some stat where it used to be like what amount of work have you had to turn away, or what percent of firms have turned away profitable work, and it was
Right. It was like a quarter. Yeah.
yeah, it's a
25%.
non-trivial number. So
Right.
that gives you that bandwidth to sustain, assume your financial management and operations are all in order, right? The whole point of why you save today, even if times are good, is that there will be bumpy moments, or plan accordingly to kind of weather those storms.
Well, I think we are out of time for questions. I do want to make sure we get the QR code up for folks to be able to download the report. I want to make sure to thank all of our donors who make this research possible. Without them, we would not be able to deliver this information. Thanks to all of you who are completing the surveys, because that obviously is critical to the success of these projects as well. And as Joe said, we do have that mid-quarter. It's a quick pulse, 5 questions. If you haven't yet filled it out, please do. I think there will be a reminder that goes out tomorrow, so you might see that in your inbox. It literally will take you less than a minute to complete, and it will help us be able to deliver some information to you next week very quickly on how any of these numbers might be changing. This is the QR code to download the full report. There's a lot more data than we were able to share today. A lot of that breakout data by geographic region, firm size, etc. So please make sure to grab that. And until next time, Thomas, Joe, thank you so much, as always, for all your insights, and we'll look forward to seeing you soon. Have a great week, everyone.
Thanks. Thank you.